Hi everybody, Frank Finance here. My name is Frank James. This is a little bit of a different video that I'm going to be doing most of the time. This is going to be a current events, really for just the week ahead. There's a lot of talk going on right now, and so I just want to get some information out on three specific pieces of information. So this is shot on March 7th, 2021. So take that as when you do consume the video. So three things is the 10-year Treasury rate. There's a cycle out of growth stocks right now, so a lot of the big caps are down quite a bit. And then Congress slash Senate, they just passed another $1.9 trillion stimulus package. And so I want to talk through each one of those things, tell you what each one of those things really means, and my thoughts at the very end of what it means for you. So when we go into the 10-year Treasury rate, most common people, they're not buying Treasury notes. Usually it's bought by institutions, they're bought by foreign governments, but why does it matter? It kind of ties back to how companies are valued. And one of the most common methods, there's three big ones, but the one we're talking about is discounted cash flow model. Inside of that calculation, there's a very important number that's tied to this 10-year Treasury rate, or just Treasury rate in general, and that's the risk-free rate. Risk-free rate is essentially what you can expect to get on a risk-free asset. Now, these Treasury rates, or the U.S. Treasury notes, are typically considered risk-free assets. They've never defaulted. You're pretty much almost guaranteed to get that return. That's why they call it a risk-free rate. But you should know every asset is risk. But consider this is what is calculated in that risk-free rate. Now, another important piece of this is the risk premium. So you have the risk-free rate, which is basically risk-free, as the name says, and then you have the risk premium, the thing you're going to invest over instead of the Treasury note, for example. Now, the difference between those two is what's called the risk premium. The risk premium is what's used in that discounted cash flow. So it's basically the risk premium minus the risk-free rate, and that's going to give you, wait, did I say it right? Yeah, the rate of return for whatever that individual security is minus the risk-free rate, and that's your risk premium. The risk premium is different per investment, and so that's what's used in those models, and that's why they're usually calculated on at an individual level. So the risk premium is going to be different on Amazon than it will be on Apple. They'll probably be fairly close, but for example, Apple is going to be very different from, let's say, an AT&T or an oil company, just because of the different types of business models and how they run and current valuation versus a tech versus an oil versus a telecommunications company. There's the discounted cash flow model doesn't necessarily take that into concern, but the returns they get on their investments that is different. So that's kind of besides the point, but that's why the 10-year Treasury rate is important. So what's been happening is that rate has been slowly increasing. I think it's in the 1.5, 1.6%. But again, here's what I think is going on. As that rate starts to go up, that risk premium starts to go down. And as the risk premium goes down, this kind of leads me into my second point, is these growth stocks, is those companies become less valuable, at least in a discounted cash flow model. And that's what a lot of companies are valued at. It's one of the three main, and I'll make a video of the other two later. But in the end, here's my take on the 10-year Treasury. You have a 1.6 rate of if you even want to invest in that, but you also have inflation that sits historically in the 3 to 4% range. So you're still going to be losing money over the long term if you do invest in that. You'll be losing that, again, 1 to 1.5% just in inflationary alone. Now, it's better than parking your money in cash and losing that 3 to 4% a year. And then there's also, another topic people have been talking about is with stimulus packages being bought is what's going to happen to inflation? Is it going to stay in that 3 to 4% range, or is it going to be increasing to 5, 6? And as that happens, the cash on books of value of companies will go down, and so that will basically the dollar becomes less valuable, and so the companies that are holding dollars become less valuable as well. So that's really why the 10-year Treasury rate, my take is it's kind of a nothing right now. If that rate goes up, another 2 points, I think we'll be in it's a little bit of a different time frame, but I don't think the Fed is going to let that happen in the short term. They may after maybe a year, and the reason why I believe that is they just pushed, as I'll go into, they just pushed out the unemployment benefits till September of 2021. So I still think there's the Fed is gonna follow Congress in this action and still provide support to the financial markets. And with that, they're gonna try to keep inflation down and keep the Treasury notes stable to stabilize the market. That's my personal belief. Who knows what they're going to do? Now, this next one is actually pretty interesting. The cycle out of growth stocks. I personally saw this as expected. You kind of look at these large companies. You look at your Amazon, your Apple, Tesla, Microsoft. The performance that they had in the last 52 weeks has been great. I mean, if you put money in a year ago, you're sitting pretty. So the losses you would have had in the last month, they're short term. Who cares? But if you if you invested in the last month, yeah, you lost you lost a good amount of money. So historically, I think these companies ran up faster than the S&P. You kind of look at these things. Let's look at the numbers. Okay, so looking at Amazon, you see that they made 55% in the last 52 weeks. Apple made 48% in the last 52 weeks. Tesla up 453%. It's insane. Microsoft is up 65% in the last 52 weeks. Compared that to the S&P 500 of up only 27%. So most of these doubled what the S&P was doing. And the S&P, I think in 2020 was up 15%. So it's up another almost 10%, 15% since the end of the year. So I think 10% since the end of the year. And then you look at the price comparisons in the last month, and it kind of makes sense. Amazon is down 10%, Apple's down 11%, Tesla's down 30%. I think high was somewhere around 900s. Now they're back in the $600 range. So you could probably expect that one to drop a little bit more. But again, huge run up, and you have this decline, and people are acting surprised. Same thing with Microsoft. They're up 65%, and they're only down roughly 4.5%. And then when you compare that to the S&P 500, it's just down 1% in the last month. So even if you would put money in at the beginning of the year, you're still up if you just put it in an S&P 500 fund. So it really, my take on this is that these stocks had huge run-ups right after COVID happened. Most of them, if you take from their low, they were all approaching 100% gains. So if you invested, I think around March 23rd of last year, each one of these, besides Tesla, I think Tesla was up almost 10x. But Amazon, Apple, and Microsoft, they were all really close to 100% gains from the March lows of COVID. So again, huge run-ups compared to the S&P. I mean, they had huge runs, and I think there's a little bit of a back here. But people are really pointing to that Treasury number, and that's kind of where I'm like, I don't think the Treasury number is, while it does affect the cash flow, the discounted cash flow model, it doesn't take a genius to look at their charts compared to the general market and their growth rates and decide that they had an extreme run. They're due for a pullback. So it doesn't. I think it was to be expected. I think right now would be a good opportunity to dollar cost average. So dollar cost average is just putting money into these companies over different periods of time, because this could continue to go down, but as you buy more into the future, you'll just lower your cost base if it goes down, and if you buy now and it continues to go up, you made a good decision to buy. So again, all these are long-term plays. Tesla is probably just full disclosure. Tesla is probably the biggest potential for downside in the short term. So just keep that in mind. Third topic is on stimulus. So $1.9 trillion in stimulus. This is the third stimulus package in the last year. We had a $2.2 trillion CARES package, and then we had a $900 million package 3 months ago. I can't remember exactly, but it was not very long ago. And now we're at another $1.9 trillion. So for $5 trillion in the last 5 months, that's a ton of cash. That's a lot of money flowing into the economy. That's a lot of money flowing into markets. And so just a high level overview, $1,400 a person. I think I'm going to look at my numbers here. The families making less than $160,000 a year will receive $1,400 a person. And individuals making less than $80,000 will also receive that money. One thing I thought that was interesting in this one that was different in the last two was if you were an adult dependent, for example, if you were being claimed by your parents, like you're a college student or something, you were not getting payments in the last two. They changed that in this one, and now you will be getting one of those payments. So just keep that in mind. If you are in college and you're claimed by your parents, you would be due part of the stimulus money. Another important thing I alluded to earlier in the video is the unemployment benefits did extend till September 6th, so there's about another 7 months worth of support there. Again, I think employment's sitting at around 6%, 6 or 7%. I can't remember off the top of my head, but either way, I'll put it in the video here. But again, I think as this number continues to come down, I'm hoping we can get to a more normalized unemployment rate here within the next year, and everything can start opening up. I think this is a lot of money. So from a financial markets perspective, this is a good thing. But and here's the kicker. Most likely financial markets have already priced this in. And so just keep that in mind. It doesn't necessarily mean it's a good time to buy just because they're putting more liquidity into the market. It just means that there's going to be more money coming. And again, they've been talking about this for months, so it's, again, to be expected. Shouldn't make any decisions based solely off of this. So there you have it, guys. That's kind of the three main things I just wanted to touch base on. The 10-year Treasury rates of the 10-year Treasury continue to go up. That's going to cause valuation models to lower the value of stocks in general, and it's going to increase the price of bonds. How long that's going to last and how far that's going to go, I'm a little skeptical because I don't think they're going to let that happen. And by them, I mean the Fed. Cycle out of growth stocks. Again, I think most of this is to be expected. It's not super surprising to me. They had a huge run up, and now they're having a slight pullback. So if you invested in the last month, hang in there, dollar cost average into it, and hold your cards on most of these. Be wary on Tesla, at least in the short term. But some of the big names, these companies aren't going away, so you can continue to invest in them. Now for the stimulus side, again, this is a lot of money. Most Americans should be receiving some more, another stimulus check. So be on the lookout for that. And my final thoughts on this: the stimulus and combined with the 10-year Treasury rate continue to go up, I think, and I think there's going to be a short-term contraction in the next probably 2 to 3 days. With them passing the stimulus bill, it just confirms what we already knew and what we expected to happen. So as Monday comes, most likely there will be a small sell-off, and then people will start buying again, and probably by the end of the week we'll be about where we were at the end of the week. That's my opinion. Again, a lot of cycling out of growth stocks into value stocks, and it's just because they're still down. A lot of these value stocks are still down since the pre-pandemic, their pre-pandemic highs, and people are seeing value there. So anyways, thanks for watching my video today. Like, subscribe, comment anything you have questions about, just put them in the comments. My name is Frank James, and this is Frank Finance. Thank you for watching. Have a great weekend. Bye.